to new sources of capital in the digital infrastructure stack. As you know, digital infrastructure is scaling faster than ever, but the capital behind it is changing just as quickly. We're seeing now new investor classes entering the stack: sovereign funds, hybrid infrastructure capital, credit platforms, and strategic corporates, and they're no longer passive. With that, I'm happy to introduce our panel. We've got Marcia Cameron, Head of Real Assets, Direct Private Markets Investments at Rest. We've got Derek Xu, Head of American Real Assets, Mid-Risk Investment at Australian Super, and Obinna Isiadinso, Global Sector Lead for the International Finance Corporation, Global TMT. Guys, thank you for joining us in Honolulu.
Thank you.
Before we dive into the questions, just a very, very quick overview of where you focus your capital allocation and geographies, because that will help us paint the picture for the conversation. Maybe starting with you, Marcia.
Thank you. RES is a $110 billion super fund based in Australia. Most of our capital, 75%, is offshore for real assets, of which most of that is based in the US and the rest in Europe, mostly in the UK.
Derek?
So our fund is $260 billion worth of members' assets. We primarily focus on direct and indirect infrastructure investments, more OECD, less in emerging markets.
And Obinna?
Yeah, thank you. So the International Finance Corporation, we are the private sector arm of the World Bank Group. So we're investing in infrastructure projects and private sector companies across sectors in emerging markets, developing markets globally. We are a balance sheet investor, so we're investing off of a $100 billion balance sheet. We essentially have an evergreen funding structure. Our shareholders are essentially 120 countries that are shareholders of the World Bank Group. And so essentially, most our investments are all self-liquidating. And as we essentially exit from investments, we're using that capital to reinvest and make new investments globally.
Yeah. Thank you. So digital infrastructure has really moved from being a niche asset class into a core global allocation capital for investors. We are living in a very challenging, changing world, uncertainty, with a lot of uncertainty as well. When you look into the macroeconomic environment, what do you think are the forces that are driving most new types of capital into this space?
You want to start?
Yeah, we can do this.
Okay. So economically, investors are looking for long-term capital that provides stability and growth, and that's one of the key drivers when you look at infrastructure, digital infrastructure. Then geopolitically, there is a lot of focus from every nation on data sovereignty and energy supply. So that's also a key driver for the sector. And lastly, technologically, when you see what's going on with AI and data. So those are the three, for us, key drivers when you think about thematics that put us on the top of the list.
Okay, and Derek?
Yeah, I think for me, like if you look 15 years ago, digital infrastructure was kind of towers, and there's some cables, but people have lost money on them. So you kind of, it was like, oh, there's only so many towers I can buy, and so it was relatively niche. And I think, you know, in the last particularly 5 years, as data centers have taken on more and more of the oxygen in the room, and you've got more assets with longer contracts and kind of less questions around technological obsolescence, and just kind of, okay, if the hyperscalers are doing it, we should be part of it. I think part of it's just index, fear of missing out, and look, I think there is conviction that, you know, there's much more to go in terms of this being an asset class that isn't subject to huge technological disruption, at least on the infrastructure side.
Fear of missing out, as simple as it sounds, it is real in this space. Obinna?
Yeah, I think, you know, for us at the IFC, you know, we are a commercial investor, but we're also a development finance institution. Every investment that we make needs to earn a commercial return, but it also needs to show developmental impact. And so what's important to us is when we look at digital infrastructure, it provides an opportunity to make an impact, you know, in developing and emerging markets. You know, for example, when you look at, you know, data center capacity globally, you know, Africa represents 450 megawatts of capacity, but the population in Africa represents 15% of the global population, but less than 1% of data center capacity. When you look at mobile penetration, you know, the global average is 70 to 80%, but in most emerging markets, it's 40 to 50%. So being able to invest in digital infrastructure provides us with an opportunity to help to close that gap in terms of the digital divide.
I think sometimes a challenge that often gets overlooked, it's actually there's so much opportunity that it's very easy to lose track, lose sense of where to go. When you look into where to invest and how to invest, how do you carry the process? How do you decide where to go? How do you go? With what fund? With what partners? Talk us through the framework.
So we invest through the whole capital stack, from venture capitals to infrastructure, core infrastructure to value add. So the way that we think about it, we look at everything and we try to understand the risk and the returns for each opportunity, and then we will play where it does make sense. So in venture capital, we will look at who the partners are, and perhaps we look at AI solutions, whereas we look into data centers from a perhaps real estate investment perspective or an infrastructure perspective, and then we might look into fibers and towers in between. So everything is around what is the risk return, and then we will look into funds to credit to PEs.
And Derek?
Yeah, I think if you also lift up right at the top, like the Australian superannuation system, we're all kind of, we're friendly, but we compete. And so firstly, it's kind of around, okay, like how at the top of the house does asset allocation work in terms of how much core exposure in infrastructure or real estate does the top of the house want versus development, that kind of thing. So that's kind of firstly the asset allocation piece. And then secondly, we kind of think around, okay, what is the best way to kind of get into some of these thematics? Can we do it ourselves, or should we look to partners to do it? And so I think at the higher end of the risk spectrum, like very, very much similar to what Marcia has said, in venture, PE, we're largely doing funds, and even in venture, for the size of the fund, it gets difficult to move the needle, so we don't do that much. As you kind of move down the risk curve, it's more kind of funds, co-underwrites, co-invests, and then kind of nearer to what we know better, it's more direct. And then if you move to credit, like our credit team, in terms of the cost of originating and executing on credit, there's a bit of a balance of using external managers as well as using an internal team for kind of the larger infrastructure investments where it makes sense to have that kind of team.
Yeah, for us, let me take a step back, right? So globally, we have a little over $3 billion invested in digital infrastructure, and that's invested across towers, mobile operators, fiber, broadband, data centers, as well as some media. And we've been investing in digital infrastructure now for 25 years. So we were one of the first lenders to mobile operators in Africa, Latin America, and Asia. We were one of the first investors in towers companies in emerging markets globally. And so we look to develop a diversified portfolio across all of these different segments. We do have also a regional strategy, and so we have a LATAM region, Africa region, Asia, Middle East, and Eastern Europe. And so we have investment teams in each region who are actually investing across infrastructure. So in addition to digital, we're also investing in power, transport, water, utilities as well. From a financing perspective, we're very flexible, and so although 70% of our balance sheet is actually senior debt, direct debt financing to projects and to companies, we're also an equity investor, so we're co-investing with other sponsors, and we're a medium to long-term investor, so we're typically invested from 7 to 10 years on average. Whether it's on the debt side or on the equity side. We're also a mezzanine provider as well. The majority of our investments are actually direct investments in companies and in projects, but we do also make investments in funds in emerging markets as well, and we'll co-invest with our managers as well.
I mean, you mentioned flexibility. A lot of these business models are flexible and fluid, and that's down to the pace of the development of the sector as well. How does your approach, in that sense, change as you move up and down the stack, the capital stack? And what are the risks and maybe some of the return levers of changing the approach along the way?
So for us, we think about the concentration. So when we invest in PE and ventures, we do it always through funds, and we play with the concentration given the risk return. So from our member base, the people that give us the money to invest are young, so that means that we can invest in high growth, perhaps assets compared to other super funds, depending the average age is for our members 30 years old. So we take a much longer view when we're investing. So that's for ventures. When we go into infrastructure, we will do it through a hybrid model. So most of the investment is 50% in funds, 40-something in co-investments. So we put large checks, and we have on a number of fiber assets on that. And then we go very small directly. And for credit, it's diversified as well. We go through funds, and it's a much more smaller. So when we think about risk return, if you like, for value add and high risk assets, a very small check, if you like, a very small concentration. And once we go closer to co plus, we can go very large on those. So we manage our risk return based on those, managing concentration limits.
Okay. Yeah, look, we're, I think broadly very similar in terms of utilising GPs at the riskier end. I think with kind of more core infrastructure, that's where we've been doing more direct. I think there's kind of some learnings there where that end of the risk curve where you've got more kind of defensive assets and where you can be a very long-term holder. That fits really well for our portfolio, and we want to hold on to those types of assets. Whereas where you're kind of a bit more value add in the infrastructure world where maybe margins are lower, there's more competition, there's more of a go-to-market strategy or development, that's where you want to pick the right partners to invest alongside, and that's kind of how we focus around picking the right GP partners and then leaning into co-investing, co-underwrite where we can.
Yeah, for us, I would say a couple of things. One is on the equity side, when we're investing, we're typically investing, anywhere from 20 to 100 million. But we're capped out in terms of the stake that we'll take in a company. So we typically won't take more than a 20% stake in a project or in a business. And so we tend to be a significant minority investor, but we want to have similar rights as other private equity investors will have. On the debt side, we have a bit more appetite. So we can lend anywhere from, on the low end, 10 million, but up to potentially $1 billion. And we're able to do that partly because we will take some exposure from our balance sheet, but we will also bring in other lenders as well. And so we have, whether it's local lenders or regional lenders, some international lenders, or even insurance companies that we're able to co-lend with and bring them into a syndicate potentially. So that's a big difference. That's where we're able. And I should say on the debt side, we do have some constraints. So for example, we will lend, let's say 30 to 35% of a project. We'll take that exposure on our balance sheet, but we can then syndicate and bring in other lenders for potentially another 30%. So we have certain limits in terms of how much exposure we're willing to take, but we tend to have more appetite in terms of providing debt financing. So given that we're essentially a commercial lender, our capital, we think, we spend a lot of time thinking about how we should deploy our economic capital. And so our equity capital is very expensive, as you can imagine.
Actually, just picking up on risk and as a follow-up, how has risk-taking or risk appetite changed in the last 12 months, and especially taking into account, again, uncertainty, it's harder to plan for longer periods of time. How has risk appetite or risk-taking changed from an investor's perspective?
So digital infrastructure is one of the thematics that we're focusing from a fund perspective, and it's one of the largest allocations that we have for infrastructure alongside renewable energy. The way that we look at risk is really trying to understand from a geopolitical perspective and technological perspective, and for us is finding a partner, GP, like Derek mentioned, that has that operational expertise, and then trying to be a little bit cautious on what the assumptions are in terms of long term. But it hasn't changed our risk appetite. It's just that we are much more focused on the risk drivers and who do we work with. And because when we go co-investments, we take larger stakes, like $1 billion perhaps or more. So and on those cases, we have the opportunity to hire non-executive directors. So we focus on having people on those boards that understand the asset operationally as a way of mitigating the risks. Because the teams are small, lean, we're not at all, we don't know how to run data centers or towers. That's not our skill, and we're not there to run the assets. So by having those experts helping us, we're sort of managing those risks.
Okay. Any other thoughts on risk?
I think what we've been very focused on is just how much development risk we have overall. I think there's just been kind of globally examples of just supply chain kind of delays, kind of construction blowouts, that kind of thing. So we've been very focused on just managing the level of development risk we have across the portfolio. And I think whilst there's a lot of noise globally, we're very focused on, okay, if AI does appear to be driving a lot of productivity gains, or I guess depends on who you ask, but our view is AI diffusion is in the early innings in terms of a house view, and if you are to invest anywhere, then you still need to be invested in the US. So from a global macro perspective, we do think of relative value. We think, look, like maybe there's more to do in Europe than we might have thought previously, but we're still kind of very much investing globally. Particularly across listed assets where it's much easier to kind of pivot the portfolio.
Yeah, look, I think a couple of things on risk. I think in the markets, investors, I think, are perceiving that we're in a bit of a higher risk environment. Rates have been increasing, and that has put pressure on companies in terms of debt service obligations, higher interest costs, and so it's been a little bit more difficult for companies to refinance potentially in certain sectors, and so that has contributed to this perception. And when you look at volatility in the markets over the past 12 months, I mean, there have been some, I think it was April last year where there was a 30% drop. So there's definitely been this perception about increased volatility. I lead data center investments for the IFC, and in the data center sector, we've seen a lot of growth. We're the largest investor in digital infrastructure in emerging markets globally, and so we're seeing a lot of activity. But in our markets, in emerging markets, we're seeing a lot of investors step back because they're not comfortable with whether it's macro risk or currency volatility or a number of issues that are happening in these countries. And so that's creating a bit of a void in those markets in terms of financing. So that creates an opportunity for us to lean in and try to support companies in the sector. But yeah, and the other issue has been there's a perception of a potential bubble in artificial intelligence in terms of infrastructure, and so that's also been a bit of an issue as well. So for a number of reasons, there appears to be more volatility and more sort of perception of risk. But when you look at the fundamentals, there's still quite a lot of demand, for this infrastructure, for the services that are associated with data centers and AI infrastructure. So that is something that we're seeing in the markets globally.
I think on the AI bubble, I think it's more of a timeline issue than a bubble.
Yeah.
But just follow up to that as well, because I mean, things are changing almost on a 48-hour basis. We saw this morning on the back of Davos, stock markets went to the red. How do you allocate capital? How do you plan with what's happening? Will this scare off new investors? We're talking about new source of capital, but could there be, and we spoke about FOMO, but could there be a point where some new players will not even dare come into the market just because the wider financial markets are not cooperating? How do we go from here? Because things will change dramatically over the next 6 to 8 months.
Yeah.
So we think and we'd separate perhaps listed from unlisted. So my team sits in the unlisted space. So the funds takes a very long-term perspective. We're constantly monitoring what is going from a geopolitical basis. And then if we take it a step back on digital as a thematic that we want to invest as a fund, we try to isolate a little bit the noise. And to Derek's point, we don't take development risk. So because we're smaller, we're much more risk adverse. So we try to sort of play safe with the partners that we know, in the geographies that we know. That's why we have a very small number of places that we will go outside Australia. And then we play with concentration limits. We believe in the sector from a long-term basis and the long-term drivers that are there. And well, hopefully we have all positive bets, but hopefully we understand that some of them are not going to go as we expect. But if you need to sort of try to eliminate the noise from what are the fundamental drivers for the sector, and we believe that those drivers exist. So we're trying to distill what is the key, that's going back to the risk returns and where are we best to play? Are we best to put this into the bucket of credit? What in the capital stack do we want to go? Or if we're going to go into equity, perhaps we look at this as a venture, we put a really little bit of money, or we go very large because we believed in the asset, and every jurisdiction, even in the US, is very different, and the sponsors will give you the operational capability and expertise, will sort of back or hopefully remove some of the noise.
Okay, any other thoughts?
I think in your question on like whether new capital will hold back, I think there is a bit of just like indexation where folks, like I think early investors in digital infra data centers are probably over allocated because it was a small investment, now it's become a big investment. But I think there are still many funds that just are under allocated, and I think also particularly with folks shifting allocation from real estate to infrastructure and needing to fill up that allocation. I think there's plenty of institutional capital on the sidelines kind of looking for a way to get into the space. And I think the other big thing that we're grappling with and thinking about is if you start being able to put kind of private equity infra funds into your 401k and that kind of growth of, kind of high net worth or like kind of individual pension capital, I think that will be a big driver of kind of incremental capital available in the space, although, question how quickly and how much, but it's definitely something that we're doing a lot of thinking about.
Okay.
Yeah, I think for us, we have, as I mentioned, $3 billion allocated to digital out of a $100 billion balance sheet. So we still have a lot of room to grow in terms of supporting digital infrastructure, globally. And I think institutional investors on average have something like maybe 5% allocation to digital. So it's still quite under allocated. I think in the data center space, there's this perception that a lot of capital has gone into data centers already, particularly in the U.S. So it's possible that you may see some sort of potential slowdown in terms of new capital. And there are a number of investors who want to get in but actually don't know the data center business. They're not familiar with how the dynamics of the sector works. So they have to be careful. But when you look globally, there's still the supply-demand dynamics for most digital infrastructure, especially for data centers and AI, is still quite attractive. There's not enough infrastructure, and there's still quite a lot of demand. And so I expect to see more capital flowing into the sector, especially in our markets in developing and emerging, where we're significantly underinvested. So, for example, in Latin America, all of LATAM makes up, let's say, 1 gigawatt of data center capacity. India is something like 1.7 gigawatts alone. Northern Virginia is about 4 to 5 gigawatts, and Northern Virginia alone is the largest data center market globally. So, a country like India, which is 1.3 billion people, there's significant room for them to grow. So there will be more capital that will flow into these markets, and so ultimately it'll be a market by market sort of decision in terms of will this market be able to continue to attract capital, or is there enough capital there already?
I think a positive thing that we've seen over the years, especially in recent years, is that this industry, it doesn't matter how the world behaves, the demand is there. We can get through it. Yeah. We've gone through Brexit, we've gone through COVID, we've done a lot of things in South China Sea. So things do evolve in the industry. We'll open up to questions to the audience in a second, but just one final question before we get to that. In terms of passive capital versus active ownership, that's been a change as well in the industry. We've seen a lot of investors coming in, they take board seats, they are really, really embedded into the strategy of the business. Why is that happening now within the digital infrastructure space? And where do you see them creating most value or destroy value as well? How is that changing?
It's a lot of capital going in the sector, as you said, and there is the perception and risk from my team or my company that there is still a lot of technological change and we are very far away. So we are not management. We have management teams managing the asset. So it's a very far distance between what is going on in the business and what we understand the business. So when you put a large chunk of capital, you want to ensure that what we call active ownership is ensure that we have access to the information. Two reasons, so we can understand the risk, ensure that we price it not only upfront but through the life. But also we are heavily regulated. So when we assign a value on an asset, we get our regulators scrutinizing the value. So we need to understand on an ongoing basis how that asset is sort of performing. Then secondly, the active ownership is around having a board or an expert that can sort of translate what's going on in the business. Most of these assets we're buying on a large growth for the asset or converting into platforms. So when we are asked to constantly put capital, we need that board member or strategic advisor, if it's not a board member, to explain us the risks and the potential rewards that we can translate it into a model and ensure that it works with our assumptions. And so that's the positive. What I've seen the negatives happening is when there is not alignment. So we always work with GPs, large GPs. So you need to ensure that there is an alignment between the GP and the minority investors, because otherwise you don't want to get 10 different voices providing different ideas to the management team. It gets convoluted, and also in particular when you go through key decisions that like large capex or dividend recaps, or you are looking at M&A. So the alignment is where if it's not really well set up at the beginning or through documentation, things can destroy value.
Makes total sense.
Yeah, I think that it just gets to a point for many pension funds, institutions, where you're at a size where the checks you're writing are, whilst it may be only 10 to 15% of a business, it's still $500 million, right? So I think like part of the drive is for folks to actually go, well, if we're putting that much into a single asset, we should have some kind of direct governance and direct insight into what's going on in the asset. And then I think importantly, similar to Marcia's point, you want to have folks on the board who are aligned to your interests, so they understand who you are as an investing organisation, but they're also additive to the board. So, if we only put internal executives on, we can talk a lot about investments and what the cap structure should be, but go to market, development, that kind of thing like that would be missing, right? So I think importantly for us, it's for the non-exec directors finding the right types of people who both understand who we are, but also understand the business, and that gives us kind of the best leverage to influence the businesses that we invest in. And I think where we see it be most successful for us, it has been more at kind of core plus or core assets we're holding for long term or invested with others that have a similar view. I think that divergence of just kind of maybe investment horizon and that kind of thing does make things more difficult, which is not to say they don't add value, but it's just sometimes a more divergent conversation around the board when folks have different horizons and risk profiles and kind of capital deployment desires.
I think for us, our goal really is to make more of an impact in terms of every investment that we're making in emerging markets globally. And so even though we tend to be a minority shareholder, we will take board seats and we will look to work with other investors and support the management team in terms of helping to expand the business. But we are looking to ensure that the companies, the projects that we're investing in, they have the right environmental, social, and governance sort of frameworks that will enable them to make the type of impact that we're looking for. And so that's why we're keen on taking more of an active role to a certain degree. The private equity funds that we're investing in will take even a much more active role than that. And so from an equity perspective, we are looking to be a little bit more active in these investments, but it's really to ensure that in addition to supporting them, that these developmental impact goals that we have are also being achieved as well.
Okay, we're really marrying tech, capital, infrastructure, and structure together. Do we have any questions we'll do both questions, but yeah.
Question about, first off, thank you all for being here. Question about your guys' investment criteria. So outside of check size, risk return, all the drivers, what's something that each of you would consider a deal maker and a deal breaker that companies or the projects may not be aware of that you guys are looking at?
I can start with the deal breakers. So because of our member base, we are really focused on sustainability. So one of the key criteria, even before returns, it's looking at the company, and if we're dealing with a GP, the GPs focus on sustainability. So how do they think, what are the ESG policies and how they're going to drive sustainability objectives? We truly believe that you achieve returns through appropriate sustainability. So for us, that if the companies that we're going to be investing in don't have the same or don't are in line with our sustainability objectives, we will not look to invest in them. And that goes from all of them, inclusive reputational as well.
I mean, there's a lot. I think I think the first fundamental focus is do you believe in the management team, right? Mm-hmm. They are going to drive the results for you. So, in terms of your question of are they aware of it, we are, we're doing our checks on who they are and.
Something beyond that, because I think most groups, stack, try and stack that teams
Yeah.
That's the most common thing you look through your deals. It's nope, that kind of that thing that maybe some folks are overlooking.
Look, I think I think that on the development side, I think there's been a lot of how are people thinking about supply chain delivery? How are people thinking about forward orders, penalties, all that kind of stuff, right? It's all there, and it all gets back to risk return, right? So how are people kind of looking at delivery has been a big part, one of the big things we've been looking at, and I guess kind of less kind of really immediately obvious, we are doing a lot of thinking about kind of longer term asset resilience. So actually kind of looking at, if this developer is developing 20 data centers or 20 single multifamily buildings, where are they in terms of flood risk or fire risk and that kind of thing, right? Which, increasingly is very front of mind as you see some of these things happen.
Yeah, I would just add that, for us, deal breakers for us really are around IDD types of issues. And so, we'll definitely walk away from investments when there's any sort of potential issues by the sponsors in terms of any sort of IDD related issues, because the last thing we want to do is wake up and see that someone, a sponsor or a company that we have invested in is showing up in the news for doing something that is that goes against World Bank guidelines and policies. So that's a big no-no for us. I think probably in terms of what helps deals go through for us really is sponsor track record. That's really important. And so even if a project is in a difficult market and there's potential issues with the structure or other aspects of the project, the fact that the sponsor has a lot of experience and has a track record of success in that sector, that goes a long way for us actually. So.
I hope that satisfies. We'll do a question from you as well, quickly.
What's your target rate of return for new investments today on a blended basis? And the follow-up is, based on the state of the markets, are you in a position yourself to take more risk for higher returns or lower risk for lower returns? So let's assume you can't say I want to stay the same. Are you risk on or risk off generally?
So as a superannuation fund, all of us get benchmark on a monthly basis, and we need to target, we have a return of around 8 to 9% for the whole infrastructure portfolio. So this is a large chunk of our infrastructure portfolio. From my fund's perspective, we have a mixed, so we have we have investments in towers, for example, so 8 to 9%, to some value at fiber, 15, 14%. We will perhaps not go into a 20% development data center because of the risk, but we have exposure to venture capital in AI solutions that will be north of that. So the answer is we need to achieve at 8, and we have a conservative board in terms of decision-making purposes.
Kind of a kludgier answer to your question is there's a risk margin on a risk-free, right? So like for the same risk profile as like 4 years ago, we need more return. That's just kind of how we're looking at it. And we are looking at making new investments. I think I mentioned we have a lot of development exposure across all of our portfolio, and so we are trying to look more on the kind of core plus stabilized end for new investments on our account. And not necessarily because we don't think you can make good returns on the development end, it's just we are very full up in terms of asset allocation.
Yeah, for us, in terms of the equity investments, we're looking to earn a similar return as other private equity firms would earn. So even though we are a developmental impact investor, we are still looking to earn similar types of returns. So 20% IRRs in 5 to 7 years typically. On the debt side, we're going to be very similar to other lenders, especially in dollar financing. So, whatever you're seeing out in the market in terms of dollar rates, we're going to be very similar. In terms of local currency financings, we're going to be a little bit more expensive. So that will be a difference. In terms of risk appetite, we will have a little bit more risk appetite, as I mentioned earlier, because we are seeing investors are backing away from several of our markets globally because of this increased perception of risk. So that creates a bit more of an opportunity for us. And the fact that we are more of a medium to long-term investor, so we can be a little bit more comfortable because we're taking a bit more of a longer-term view. I think for us, because we have also been invested in emerging markets for 60, 65 years, we have offices in over 100 countries globally. We have relationships with local clients, with governments, with regulators. So we have the ability to get our heads wrapped around the risks, whether it's macro risk or other risk in these markets that other investors sometimes struggle with. So we do have a bit more appetite to take on risk. But we are conservative as well. So from a credit perspective, we won't. For example, we won't fund spec development in the data center sector. So that's something that we won't do. So we're looking to fund contracted hyperscale, contracted build-to-suit types of projects and things of that nature.
Sounds good. Well, I think this is all the time that we got for. Sorry, maybe you can meet us outside, because I'm getting the sign that we have to finish. We could fill up another hour for sure. Obinna, Derek, Marcia, thanks so much for joining us. Thank you so much for sitting through the session, and thank you PTC for organizing.